American government, interest groups. The expression K Street may be unfamiliar to you, but in Washington, D.C., those words have come to symbolize political power itself. Congressional power is symbolized by Capitol Hill, presidential power by the White House, judicial power by the Supreme Court building. But it's on K Street, literally the street in Washington, D.C., that lobbying firms have traditionally concentrated on, firms that represent business interests and trade associations and citizen groups, etc. The power of these groups is not easily overstated. Lobbying touches on nearly every public policy issue at the state and federal level, and it's relentless. It's a clear election season in state and local government, but lobbying never goes out of season. How important is lobbying, or trying to get an elected member to do what you want? Consider this. There are more lobbyists operating in Washington than there are journalists covering what's going on in Washington. There are more lobbyists than there are congressional staff members. More money is spent on lobbying efforts annually than on the political campaigns themselves. At the same time, as opposed to almost everything else in Washington, lobbying takes place largely out of sight. Lobbying is done by invisible power brokers behind closed doors, but on behalf of the interests of different groups of American people who want the lobbying to occur. Let's consider the political role of interest groups, or as they're sometimes called, pressure groups or lobbying groups or special interests. They are all the same thing. Such groups have only two real characteristics. They pursue public policy goals, and they have an organized membership. Thus, not every group of Americans meets the definition of an interest group. A high school marching band, for instance, is an organized group, highly organized, but it does not pursue public policy goals. In contrast, the National Rifle Association, or NRA, fits the definition of an interest group. It has members, millions of them, and it seeks to influence policy at the state and federal level, and it spends millions of dollars a year to try to do so. A striking feature of American politics is the sheer number of interest groups that seek to influence state and federal policy. The number is so large that no one has a firm estimate on the actual number. America's great size helps to explain its abundant groups, but size is not quite as important as it might appear. France, for example, has about a fifth as many people as the U.S., and it occupies a smaller area, or roughly the size of the New England states. Yet France is large enough, with tens of millions of people, that nearly every interest found in the U.S. can also be found there, whether it's types of farmers or types of small businesses. Nevertheless, France's private interests are much less organized than those in the U.S. The second factor, the structure of the U.S. political system, is the key to understanding why America has so many diverse interest groups. Because of the separation of powers, groups at the national level have three branches to target. In one of them, Congress offers two unique targets, the House and the Senate. Each of these chambers has 20 standing committees, and nearly all of them have several subcommittees. All places where information can be shared and influence could be gained. Each member of Congress, 535 in all, is also an individual target of lobbying efforts. Under congressional rules, each member has the power to propose legislation at the national level. And that's just at the national government. Because the United States is a federal system, the state governments are power centers in their own right. Each of them is an inviting target for lobbying, with their three branches of government and scores of legislative committees and state agencies. Below the state governments in the U.S. are the local ones, with their mayors and city councils, which by tradition have their own meaningful policy-making authority. Compare the American system with a parliamentary government in a unitary system such as France. There, national political power is concentrated at the top in the hands of a relatively small number of policymakers, people who even have a major say in the policies of provincial and local governments. In some, there aren't nearly as many opportunities to secure influence, group influence in France. The point is this: if there is such a thing as an interest group heaven, the United States is it. Our federal system offers countless points of access for groups, and attempts at lobbying represent massive and coordinated undertakings to influence meta policy change. This dispersion of power within our system gives interest groups a reason to grow and to organize if they hope to effectively influence the direction of public policy, namely by influencing lawmakers in Congress directly. The possible ways to make a difference or to influence the policymaking process are nearly endless because our feature has so many connecting points. America's large number of interest groups doesn't necessarily mean that the country's interests are all equally well organized. Organizations develop when people with a shared goal or interest have the resources and incentive to work together. Those factors, resources and incentives, differ across society, with the result that some interests are far better organized than others, and thus are much more effective at influencing public policy. The most thoroughly organized interests in the United States are those that have an economic activity at their core, such as business firms, workers, farmers, unions, etc. I'll call them economic interest groups to distinguish them from other types of groups. Of the economic interests, business firms are best organized. Nearly 2/3 of all groups registered to lobby Congress formally have a business focused. Examples would include corporations like General Motors, Microsoft, and the American Petroleum Institute, which represents many of the nation's oil companies. Some business-related groups have a huge presence in Washington, D.C. One example is the U.S. Chamber of Commerce, which represents more than 3 million American businesses in all sizes and all sectors. The Chamber employs hundreds of staff members in its Washington headquarters and spends tens of millions of dollars each year on their lobbying efforts. So why are economic interests so highly organized? For starters, many of them have built-in resources as a result of their industriousness. Businesses who are members of an interest group, for example, can take some of their profits and use that money to support lobbying activities that may well generate a better regulatory climate that will allow them to make even more money in the long run. Economic interests also have a powerful incentive to offer potential group members. They provide what are called private or individual goods, benefits that a group can give directly to an individual. Corporations and unions, for example, are positioned to give people jobs. That's a strong reason to join an interest group. Compared with economic interests, other interest groups, and for ease of discussion, let's just call them non-economic interest groups, are far less organized. To be sure, some of them have imposing organizations. The NRA, for example, has 3 million gun owners on its membership rolls. Even more impressive, 38 million Americans are members of AARP, the American Association for Retired Peoples, which seeks to represent the interests of elderly populations. But these groups are exceptional. Most non-economic interest groups are poorly organized. Take college students, for example. There are millions of them present at any given time in the U.S. Although they share a number of policy interests, such as access to low-interest student loans, for example, few college students belong to a group that lobbies on their behalf. Such groups do exist. One would be the United States Student Association, yet few students have ever heard of it, and even fewer belong to it. So why the difference? Why are non-economic groups far less organized than economic ones? For one thing, non-economic groups tend to have access to far less money for lobbying purposes. Unlike corporations and unions, which can dip into their profits or dues, respectively, to fund lobbying efforts, non-economic groups have to rely on voluntary contributions. Non-economic groups also face what's called the free rider problem. Such groups seek what are called public goods or collective goods, free rider public goods. Public goods, by definition, are available to everyone, whether they belong to a group or not. For example, if the United States Student Association were to succeed in getting officials to lower the interest rate on all student loans, all student loan holders would benefit whether they belong to that group or not. That situation allows potential members to ride for free. If the benefit is going to be available anyway to everyone, why pay for the cost of membership to be a part of the initiative? Let's use National Public Radio, or NPR, as an example. It offers a public good, quality news that's freely available on the airwaves. News costs money to produce, and NPR relies on listener contributions for most of its funding. Several times a year, NPR stations make an on-the-air fundraising appeal. So how many listeners actually contribute? People enjoying the service? Only about 10%. The other 90% of NPR's listeners are free riders. They'll gladly use a public good that's just there for them, but they won't support the public good with a single cent. The fact is, non-economic interest groups depend almost entirely on the goodwill of people who believe in contributing to a cause they think is worthwhile. Despite the challenges of non-economic groups, there are millions of Americans who belong to these organizations, and these people support a wide range of non-economic groups that lobby on everything from nuclear energy to organic milk to transgender rights. At the national level, whether economic or non-economic, groups concentrate most of their efforts on Congress and on the executive agencies. Lobbying also takes place through the White House and in the court system, but these institutions are far less accessible to lobbyists, and for good reason. Congress is a particularly inviting target, with its 2 chambers and its standing committees and various subcommittees all focused on specific issues that may affect a specific group's membership. Money is a key part of congressional lobbying, not in the form of outright bribes, as some Americans tend to believe. Congress is relatively free of that form of corruption. It does happen from time to time. Every once in a while, a member of Congress does accept a bribe or something resembling a bribe, but it's risky as lobbying spending is carefully tracked by various watchdog groups. Lobbying is tightly regulated. In 2005, Louisiana Congressman William Jefferson was arrested and later imprisoned after FBI agents found $90,000 in cash in a freezer in his congressional office. He had taken a bribe from a tech company called iGate and promised to use his influence to promote their hardware for use with the U.S. Army. Such obvious corruption is very rare. On the other hand, there's a type of money that members of Congress can legally take hand over fist from interest groups. It's called campaign funds or donations. Campaign funds. And groups are much more than happy to oblige, knowing that such contributions will give them a better chance of getting a lawmaker's attention down the road. Talking to politicians is easy, but with a little money donated to a campaign fund, they tend to hear you better. Most interest group contributions occur through political action committees or PACs, political action committees. A group cannot give organizational funds such as corporate profits or union dues directly to a candidate, but a group can create a PAC, a political action committee, to solicit voluntary contributions from the group's members, which can then be given to the candidates. $10,000 is the current maximum amount a political action committee can contribute to a single candidate, $5,000 for the primary race and $5,000 for the general election. About 4,000 interest groups in the United States have political action committees, which collectively provide about a fourth of what congressional candidates spend on their political campaigns. More than two-thirds of this political action committee money comes from business-related PACs, such as Coca-Cola PAC. In one recent congressional campaign, our PAC, the National Rifle Association's Political Action Committee, spent more than $4 million trying to influence various policy initiatives. PACs are obviously strategic in their contributions. More than 85% of political action committee money goes to incumbents, a recognition by interest groups that incumbents, those currently in office, typically get reelected. In essence, PACs often spend money on who they think will win an election, not on who they want to win necessarily. They're not in the game to play favorites. They're in the game to gain influence. PACs are particularly inclined to fund incumbents who sit on the committees that deal with the policies affecting that interest group. They're the ones most likely to have influence over the issues of interest to the PAC or the interest group. Although interest groups spend tens of millions of dollars on individual candidate primary and general election campaigns each elected cycle, they spend even more heavily on lobbying. During a recent 2-year congressional cycle, groups spent roughly $8 billion on lobbying efforts. In lobbying Congress, groups typically work with lawmakers who share their policy goals. They understand that it's hard to get opposing lawmakers to switch sides on an issue. And lobbyists rely primarily on information to make their case. This is commonly misunderstood. Lawmakers react negatively to pressure tactics. That's not what lobbyists do. They don't like to have their arm twisted. But they do value information in Congress. The volume of legislation in Congress is enormous, and members rely on trusted lobbyists to identify bills and even read bills worthy of their attention. Moreover, lobbyists in a particular field often have a much better understanding of a particular bill than do many members of Congress. Most. Members deal with a lot of bills in each session. An interest group typically has only 1 or 2 bills in its sights at any one given time. I've emphasized in previous discussions how knowledge is power when it comes to policy making. To decide what to do, you first have to understand the issue. That's a reason many lobbying groups conduct detailed research, and that's where they spend a lot of their money. When they meet with a congressional member or a top staffer of a member of Congress, they're positioned to explain in detail and in summary how a bill will affect them and their constituents. Now, clearly, information alone will not get a group what it wants. That's why groups target lawmakers that they trust. They need lawmakers who can be expected to look after the group's interests as the bill is working its way through the legislative process. But that trust has to be mutual. An interest group has to play it straight when supplying information to a lawmaker. They can't just lie to them. If the information is flawed and the member uses it to argue on the group's behalf in front of Congress, the member will look foolish when the facts come out. If a lobbyist gives a member of Congress false or misleading information, that relationship is likely to be terminated. So one last thing about the relationship between lobbyists and members of Congress that needs to be noted, and it's critical in understanding whether a group is likely to succeed in its lobbying efforts or not. The fact is, senators and representatives in Washington, above all else, are politicians. When talking with a lobbyist, they're always mindful of who the lobbyist represents. Is this a group vitally important to my political career? If the answer is no, the lobbyist might get a polite hearing, but nothing more. However, if it's a yes, if the group, the interest group, is important to the member's reelection and can offer tangible reelection campaign contributions or information or meaningful support back home, the lobbyist normally can expect some help in the policy arena, sometimes a lot of it. Executive agencies within the federal bureaucracy offer nearly as inviting a target for lobbyists as does Congress. There are several hundred such agencies, and they have influence over how legislation will be interpreted and implemented in practice. Agencies are also a source of policy ideas that later make their way into law. Like members of Congress, bureaucrats depend on lobbying groups for information. Although top administrators are well versed on their agency's policies, they don't necessarily have detailed knowledge of how a policy could affect a particular group. Lobbyists help fill in that information gap. In addition, many agencies get much of their data from interest groups. For example, publicly traded companies are required to file information on their stock offerings and balance sheets to the Securities and Exchange Commission, or the SEC, which uses that data in its regulatory decisions. There are rules governing these filings and penalties for lying, but the requirements are subject to interpretation, giving firms some leeway in the information they provide the agencies. Groups' position as a source of information enables them to influence agency decisions. So too does the lobbying support they can give an agency when its budget comes up for review in Congress. Now, to help you better understand how groups operate, let's take a look at two cases, one illustrating congressional lobbying and one illustrating bureaucratic lobbying, both in the context of the 2010 post-recession Dodd-Frank Wall Street Reform and Consumer Protection Act, or as it's often called just Dodd-Frank, passed in the aftermath of that Great Recession. Dodd-Frank was enacted in response to a crash of the U.S. and global financial sectors in late 2008. The law was designed to end some of the business practices that had contributed to the malinvestments that had touched off the economic panic. One goal of the legislation was to protect borrowers from potentially deceptive lending practices that have fueled a boom and bust of the U.S. housing market regarding mortgages. Partly in response to government incentives to promote home ownership, banks, U.S. banks, have given large numbers of mortgages to poorly qualified home buyers throughout the late 1990s and early 2000s. When home prices began to sharply drop after 2006-2007, many of these mortgages were suddenly underwater, meaning the house that someone had taken a mortgage on was actually worth less than the mortgage owed on it, and the owner owed more than was worth. When the Great Recession followed, many of these buyers who could barely afford the home in the first place stopped making payments on their mortgage, particularly those individuals who had gamed the system and purchased additional homes as speculative investments. A lot of that happened in 2006, 2007. Banks were left with a huge number of vacant homes and mortgage defaults and few customers for these homes. It put some of them in the red, driving down their bank stock prices and accelerating the financial crisis. Dodd-Frank tried to address this problem by further regulating risky lending from everything from mortgages to credit cards to payday consumer loans. However, one type of lending was removed from the bill as it made its way through Congress: auto loans. That exception in the law came about when, as Dodd-Frank was being written in Congress hastily in 2009, lawmakers and dealers who spent $100 million a year on lobbying mounted a furious effort to get the exemption. How and why did this group succeed? They based their case on interest group supplied data showing that auto loans did not pose anywhere near the same systemic risk to the economy as mortgages had. An abundance of failed mortgages are one thing, and had proven to cause significant harm during the recessionary event. Repossessed cars, the data suggested, were separate, distinct, and not likely to result in a debt spiral for consumers or businesses or any agencies buying up collateralized auto loans. The used car market operates more efficiently than does the market for vacant homes, and the stakes were smaller. Yet, if that argument was all that the auto industry had to offer, it's doubtful that it would have received the exception. The auto industry also had something else to offer lawmakers. There are auto repair shops and auto supply shops and dealerships in every state and nearly every congressional district. Auto dealers are prominent local business leaders generally, as well as heavy campaign contributors. During the debate over Dodd-Frank, more than 500 auto industry lobbyists went to Capitol Hill, about one lobbyist per member of Congress, to remind lawmakers of the importance of car manufacturers, dealerships, and service centers in their districts and home states. This made a difference. The auto industry got its exemption in the law. This is after certain car companies like General Motors and Chrysler, notably, had received a special federal bailout during the Great Recession, and also after Congress initiated the infamous federal Cash for Clunkers program designed to back new car purchases with federally backed trade-in incentives. Clearly, the interest groups representing automakers have the number on Congress. Now let's shift to the case illustrating agency lobbying. It involves another goal of Dodd-Frank, the regulation of derivatives, derivative markets. Derivative is a security traded like a stock or a bond whose price depends on the assets that it holds. Mortgage-backed securities were a contributing cause to the global financial meltdown that hit the economy in 2008. Both risky and non-risky mortgages to various homeowners, depending on their credit, have been bundled together by the thousands and sold and traded as mortgage-backed security derivatives, sold to investors often with AAA ratings from credit rating agencies, the highest and safest level for an investor. It's safer to invest in than someone else's mortgage. These mortgage derivative products commanded a high price, and financial institutions made millions of dollars trading them. When the housing market collapsed, it was unthinkable at the time. It was soon apparent that many of the derivatives that had been bundled together were worth much less than what had been claimed when the product had been assembled and stamped with that AAA rating. In truth, many highly rated mortgage-backed securities were stuffed with bad mortgages to people who should never have gotten a loan in the first place. They were, in essence, pretty new houses with a bad termite problem hiding in the walls. Dodd-Frank sought to rein in derivatives after the housing market collapse of 2008 and 2009, subjecting these markets to regulation in much the way that stocks and bonds were regulated. Financial institutions did not want their derivative products subject to closer scrutiny, and they lobbied Congress to remove the regulation of derivatives from Dodd-Frank. Their lobbying effort was based in part on research indicating that some types of derivatives were actually easy for the markets to price. They also produced information showing that the proposed regulations would weaken their trading position relative to foreign competitors. Through its lobbying effort in Congress, the financial sector succeeded in watering down some of Dodd-Frank's provisions, but not to the degree that lobbyists wanted. As a result, after the bill was passed through Congress, the sector's lobbyists turned their aim on the executive agencies that would actually implement Dodd-Frank, seeking to get them to weaken the regulations during the implementation phase. 15 plus years after the recession, that effort is actually still ongoing. But even if the big banks don't get everything they want, the industry certainly got a full hearing from the agencies. According to a study by the Sunlight Foundation, which is a watchdog group, the Sunlight Foundation, federal regulators in charge of Dodd-Frank met 14 times more often with bank lobbyists than they did with consumer lobbyists. Lobbyists for Goldman Sachs alone attended 222 meetings with regulators during the policy formation phase, almost as many meetings as regulators granted to all consumer groups combined. Let's step back from these two examples of interest group lobbying. Think about the influence of interest groups in a broader context. For starters, no one questions the right of or the need for groups to speak out on policy issues affecting them. It's entirely appropriate for groups, whether they be automakers, banks, consumers, farmers, or college students, to advocate on their own behalf and in an organized way. But that's not simply because Americans have a right to free association and expression. The fact is society as a whole has a stake in the well-being of its separate interests. Where would we be without a healthy banking or food or construction or higher education sector? Those involved in such sectors should have a clear and unified voice in the policy arena. For this reason, scholars of the pluralist school of thought, the pluralist school, prefer to think of the public interest as a question of whether a large number of groups distributed across the wide range of society benefit from interest group activity. If they do, pluralists say, the interest group system contributes to the public good. Yet one can reasonably ask whether some groups have too much power in the United States. If a group routinely gets its way at a cost to the rest of society, the interests of the majority are brushed aside in favor of the minority. That situation is not easy to reconcile with democratic theory, which emphasizes government by the majority rather than government by the well-placed and the connected. That concern, however, cannot be addressed in isolation. The interest group system is only one of the ways that policy benefits in America are negotiated and distributed. The political party system is another way, and it operates very differently than the interest group system. If a specific group of individual Americans believe they are disadvantaged in some way by the interest group system, then they can use the ballot to affect a political party's electoral fortunes, which also affects public policy. And votes cost nothing and require no personal connections. For example, while business interests might get tax breaks by seeking relief through the interest group system and lobbying, Lower income Americans can and do secure access to government assistance programs through the party system in ways that disproportionately benefit them over others. My point is that the interest group system is only part of the answer to the question of who governs in America, and it's inherently a useful part of the answer. Such groups have what may be called a fair advantage when it comes to influencing the policy arena. They got organized, they put up the money, and they supply vital research and information that directly contributes to America's policymaking process. Contrary to what many people believe, I would argue that interest groups and lobbyists actually aid our system of governance and make Congress more effective than it would otherwise be. They supply information. In truth, there's one interest group that rules above all others, and we can't forget this. The American people comprise the most important singular interest group of all. Our country, built from the sweat and blistered hands of frontiersmen and revolutionaries, was established with the intent of being a land of new beginnings. Infant America represented freedom and independence as it declared itself self-reliant. Standing as the beacon of salvation to those who face similar oppression, we welcomed wandering immigrants to our shores, so long as they were willing to participate in the ideals America had established. Since then, America has become a nation of individuals bonded together through the united blanket of our American flag. Where else in the world can people of all nations come together and exchange ideas and participate so openly with one another? Divisive politics is a distraction that hides a fundamental and unflappable truth. Our national motto is E pluribus unum, which is Latin for out of many, we are one.